One of the biggest mistakes Bitcoin investors make is watching the price too closely. Bitcoin is at $60,000 today, then $80,000 tomorrow, and suddenly it drops by 15%. A new all-time high sends everyone into a frenzy, but then there's a crash. It's a roller coaster of numbers that change every single day. But if your goal is long-term wealth accumulation, those daily price fluctuations may be among the least important numbers you should be tracking. Instead, ask yourself, how much Bitcoin are you accumulating every month? This shift in perspective can fundamentally change your approach to Bitcoin investment. Rather than obsessing over predicting the perfect time to buy, consider establishing a consistent allocation from your income. Automate your purchases and keep accumulating through all market conditions. Good and bad, bull and bear. The objective here isn't to win every short-term trade. The focus should be on steadily increasing your ownership of an asset that you believe in. This leads us to one of the most powerful concepts in investing: compounding. And even more critically for Bitcoin, we have to consider compounding the number of units you own. Imagine two investors. Investor A wakes up daily to check Bitcoin's price. If it's rising, they're excited and quick to buy. If it's falling, doubt creeps in. They might even wait for a lower price, which often leads to missed opportunities. Emotions begin to dictate their strategy. On the other hand, Investor B adopts a radically different mindset. They commit to investing 10% of their monthly income into Bitcoin. This amount is automatic, requiring no daily decision-making on their part, no fretting over price. They simply follow their plan. Investor B understands a crucial insight. You don't need to predict Bitcoin's future price to accumulate it. You just need a system. Next, let's talk about the power of monthly allocation. Suppose someone earns $5,000 a month and decides to allocate $500 to Bitcoin. This $500 doesn't reflect speculation about Bitcoin's value. Rather, it's a commitment to consistently build their position. This means that some months, $500 will buy less Bitcoin if prices are high, while other months it buys more if Bitcoin is low. Instead of betting everything on a single price point, Investor B accumulates Bitcoin over time, notably through a strategy known as dollar cost averaging, commonly referred to as DCA. DCA brings about a behavioral advantage. It minimizes emotional decision-making and introduces a repeatable process. The true goal is not how much your investment has gained or lost, but how many units of Bitcoin you own over time. Now, many investors fixate only on their dollar amount. They look at their investment. $10,000 invested, then it drops to $8,000 before rising to $15,000. But consider a more foundational question. How many Bitcoin do I own? Let's break it down. If Bitcoin is priced at $100,000, your monthly $500 would buy about 0.05 of Bitcoin. But if the price drops to $50,000, that same $500 would net you 0.01 Bitcoin. So falling prices can actually be an opportunity to accumulate more units, creating a more significant advantage for long-term believers. While it's natural to want to find the perfect entry point, consider this. Two investors approach Bitcoin differently. One waits and speculates, while the other consistently buys. Who fares better in the end? The answer is unclear, as nobody can predict the future price. However, we do understand the mechanics of consistent accumulation yield powerful results over time. Consistency in accumulation is key. Each purchase increases your Bitcoin holdings, and as those holdings appreciate, your wealth grows. So, don't let a high Bitcoin price deter you. Bitcoin is divisible. You can invest whatever fits your budget. It's not about buying a whole Bitcoin, but about determining how much of your income should go toward Bitcoin consistently. You build the system before you build the position. Automation helps remove the mental exercise of deciding whether to invest, which can be tempting to skip when prices are fluctuating. Finally, consider the impact of market downturns. Everyone loves investing automatically when prices soar, but how do you react when Bitcoin plummets? That's when your strategy is tested. Stick with your established plan, And you'll find that downturns could lead to acquiring even more Bitcoin. The million-dollar question isn't whether Bitcoin will rise or fall. It's about what happens if, over time, you've accumulated Bitcoin consistently while prices are volatile. For a hypothetical investor putting in $500 a month over 10 years, that's $60,000 contributed. Now imagine as Bitcoin appreciates during that time, you could be sitting on a massive investment. So remember, it's not about trying to guess the best time to buy Bitcoin. It's about building a system that enables you to accumulate Bitcoin consistently and patiently over the long haul. Please remember, this video is not for investment advice, only informational purposes. You need to consult a financial advisor for financial advice.